Hello, welcome to the second part of the risk and return chapter. In this chapter, we are going to cover following learning goals. First, we are going to review the two types of risk and derived some form of derivation and role of beta in measuring the relevant risk of both a security and a portfolio. We're also going to look into the famous model, capital asset pricing model, and its relationship to the security market line. And we're also going to look at some of the part of it which is called characteristic line. So you'll have these learning goals. Let's go on. So CAPM, capital asset pricing model, is the basic theory that links risk and return for all assets. The smartness of this theory is that it depends only on two variables, risk and return. Now, the CAPM quantifies this relationship between risk and return. It measures how much additional return an investor should expect from taking a little extra risk. So high risk, high return basically tells us the compensation for a given level of risk in terms of returns. Now let's discuss few of the components such as risk. So in CAPM world, there is a concept of total risk. It is the combination of securities, non-diversifiable risk and diversifiable risk. From the previous session, we already know that diversifiable risk is the one where we have enough space in terms of correlation to separate to reduce the risk to reduce the risk, while non-diversifiable risk will be the one where we cannot reduce the risk. So diversifiable risk is the portion of an asset risk that is attributable to firm-specific random causes and can be eliminated through diversification. It is also called unsystematic risk. Now, let's take an example. For instance, a company, a firm, automobile, and automobile has a product recall risk. So for instance, accelerator has a problem or something and they have to recall a large number of vehicles back. This risk is only firm specific risk. It is not industry-wide risk. So how to reduce this product recall risk, because when the recall happens, the sales will fall, and also it will affect our future sales figure as well. So recall risk can be reduced by investing in another firm, in another automobile firm, which has low recalls, and hence if recalls come from this firm, from firm A, the firm B will have low recall, hence our portfolio value will not fall as much as if we have entirely invested in firm A. So non-diversifiable risk is the relevant portion of an asset's risk attributable to market factors that affect all firms. So for instance, if I say inflation affects all firms. If I say exchange rate or some other risks, macro risks, they affect all firms. Only that we don't know the real form of this risk. It's the combination of a lot of factors, and the underlying structure is relatively unknown. This is called systematic risk. It cannot be eliminated through diversification. It cannot be eliminated through diversification, and this is the risk for which market is willing to pay us a premium. Market never pays premium for diversifiable risk. Never pay premium for diversifiable risk. They will always pay premium for non-diversifiable risk because this is the risk that you cannot get rid of. However, diversifiable risk is you can get rid of by adding another assets with a different correlation structure. So market and can be done almost without any cost. So market will never pay you premium for diversifiable risk. Now you can see in this graph that we have the risk on y-axis. This is falling as the number of securities on x-axis increases. So at around 15, so I would say this is the area where the risk is reduced at an optimum level. So at 15, investing in 15 or 18 or 20, maybe let's say we say 20 assets. If you invest in 15 to 20 assets, you completely uh, reduce the risk or get rid of the diversifiable risk. You're only left for non-diversifiable risk, for which market will compensate return. Here comes the concept of beta coefficient. The beta coefficient, which is integral part of CAPM, is a relative measure of non-diversifiable risk. So we now discuss with only non-diversifiable risk. So this is an index of the degree of movement of an asset return in a response to a change in the market return. So as the market return changes, how much change in asset returns happens. This is what is measured by beta coefficient. First, we calculate the beta using assets historical returns, and after calculating the beta, we benchmark it to the market, which the market is 1. So how much beta the assets will have? So if it's 1.2, it's higher than the market. If it's it's less than 1, then it's less than the market value. So let's look at the concept of market return, which we'll use in the next slide. The market return is the return on the entire market portfolio of all traded securities. For instance, New York Stock Exchange Index, Composite Index. Now this index actually reflects all the stocks that are traded on New York Stock Exchange. Hence, any change in the index will be the market return representative of the entire New York Stock Exchange, and hence we can use this as a market return in our calculations. You can see the single variable regression. This is ordinary least square regression, and you will need to learn it for your project as well. So in this, we have asset return on the y-axis and market return on the x-axis. So asset returns are the time series, both are time series of the returns in percentages. So one is the asset return and the other is the market return. And so we have, for let's say 2000, 2001, so on, 2021. So that's how we have a time series, and these are the values, and we regress or run regression on this 2 time series. We'll have the line which is called best fit line. This is best fit line. If you don't understand these technical terms, you can leave it for now, because later we are going to run the regression and you will get a fair idea of that. So this best line means that these are the data points for 2009, 2014, 2013, 15, 12, 8 and 10. You can see these data points are spread on the axis. Now the line actually crosses in the middle. This is what we call best fit line to this data points, and the slope of this line, which is represented by beta s, is 1.3, which means if the market return increases by 1, the asset return will increase by 1.3 times. So this is what the beta is. Also, we can look at for asset R. Asset R is 0.80. So if market increase by 1, the asset R will increase by only 0.8 times. 0.8 times. Lines are called characteristic line, and you can calculate beta for each asset by using the same methodology, by running regression, keeping the market same while changing the assets. For instance, for stock number 1, stock number 2, stock number 3, or asset A, asset B, asset C, and you can find these best fit lines and calculate the beta, and this beta can be used in capital asset pricing model. Now the interpretation of beta is more clear here. You can see that the 0 is the benchmark where we have unaffected by market movement. So our asset will be unaffected by any market movement. It has no correlation with the, or no connection with the market. Now, remember, beta is not the correlation. So uh, beta, if increases by, if we have an asset beta of 2, this means that it will move in the same direction because it's positive, and it's twice as responsive as the market. So market moves by 1%, the stock price will double. If it's 1, then it exactly respond to the market. So market increased by 1%, then the stock will increase by 1% also. zero point 0.5 is when the market increased by 1%, the stock is increased by only 0.5%. So this is how you can interpret the beta. The negative means that it is on the in the opposite direction, and hence we can see that -2 means that if market increased by 1, the stock price will fall by almost double. So twice as responsive as the market, the same response as the market, and -0.5 is only half as responsive as the market, which means if the market increased by 1, the stock price will fall by 0.5%. Here you can look at different betas of different stocks. For instance, Zeros has a very high risky stock, and then we have PepsiCo, which has very low beta. So high beta means high risk, low beta means low risk, and beta itself is a systematic risk, and also called non-diversifiable risk, for which market compensates. Um, compensates. Now we can calculate the beta of a portfolio by first calculating the betas of the individual assets. So for instance, beta of the first asset, beta of the second asset, beta of the n asset, and we have to give them weight also. So we multiply with the weight of the second assets multiplied by the beta of the second asset. Same is the case with the wn. So the algebraic notation or formula that comes out to be is the weight multiplied by the beta for the jth asset, where j is equal to 1 to n. These are the number of assets in our portfolio. Once we calculate, we get the beta for the entire portfolio. Let's do an example and calculate it. So for MA, an individual investor wishes to assess the risk of two small portfolios he's considering, V and W. Let's calculate the beta for both portfolio V and portfolio W. So we have the portfolio assets. So these are the assets, 1, 2, 3, 4, 5 assets we have, and then we have the proportion of investments in each assets. So in the first we have only 0.1, and then we have 0.3. So proportion is basically what we call the weight, and here also this is the weight. Then we have the beta for each stocks given. When we multiply, then we will get the weighted beta for each portfolio. Similar is the case with the W. Multiply the weight and you will get the weighted beta of the portfolio W. Now this comes out to be the, if you calculate it, is going to be 1.2, approximately 1.2 for portfolio V, and this will be approximately 0.9. Sum of all portfolios. So weighted portfolio beta for V and beta for W will be this. And you can see that portfolio V is more riskier compared to portfolio W, which is 0.90. So if the market increased by 1 unit, the in total value of the portfolio V will increase by an additional 20%, while in case of portfolio W, it will be increasing by only 0.9%, which means it's less risky. The sudden market changes will not affect portfolio W more compared to portfolio V. This also gives us a complete form of capital asset pricing model. Now we have studied all the separate components, we can put it together. So we have a required return Rj that can be calculated by risk-free rate, RFR. We also use it the symbol as RFR. Then we have plus, we have beta, and beta return on market, RM, minus RF. There are different notation that are used across. However, the idea is that this is the excess market premium. So return on market, what market offers, RF. For instance, in this case, we can say that it's the New York Stock Exchange Composite Index, and this is the T-bill rate, government T-bill or US Fed T-bill rate. So if you multiply with the beta, beta is the stock beta, and this is again the RFR, risk-free rate, which is the same as T-bill rate. We'll get a required return on asset J. If you look at the risk premium, and this is from the earlier slides, that stocks return is 9.3% while T-bill rate is 3.9%. So the risk premium that the stocks are offering is 5.4%, while compared to bonds it is only 1.1%. So stocks are riskier, hence they are expected to compensate for higher risk, and that's what they are doing, while bonds are less risky, hence they are not expected to compensate as much as stocks are, so they are going to pay less. Let's look at an example. BCC, a growing computer software developer, wishes to determine the required return on asset Z, which has a beta of 1.5. The risk-free rate of this return is 7%. The return on the market portfolio of asset is 11%. So our CAPM that we have already discussed is risk-free rate plus beta multiplied by, so beta J multiplied by market return minus risk-free, and this will come out to be risk-free is 7% plus 1.5 times the market return, which is 11%, minus the risk-free, which is 7%. This comes out to be 13%. So now our required return is 13%. If we are going to invest in this stock, BCC, this means that we need a return of 13% in order to compensate us for the risk or for the systematic risk that this stock has due to the market conditions. So high beta means high required returns, high beta, high returns, RJ. Low beta means low beta, low RJ. So let's look at the security market line. So this is based on the equation, and the equation that we already saw, RJ equals to risk-free rate plus beta multiplied by market return minus RF. So if you can see that RJ is the required return and RF is given here while beta is given here, so the slope of the market will be RM minus RF. This is the slope of the security market line. The security market line is theoretically the correct line, which means whatever return it offers, that is supposed to be theoretically correct. Theoretically correct. It is also called equilibrium price. When market is in equilibrium, this is the price that you will receive, SML. any price on this SML. So if I go and here, or any price on this line will be the theoretically correct price. Now obviously we see that uh, the market prices of the stocks moves. Now for instance, let's take an example. There is a stock that has stock A that has a price that has a return which is 15%. Now if it's a 15% return, and this is the risk that it will get, beta, sorry for my line, so this is the stock A beta. Now this is the theoretically correct position where this uh, stock should lie on this line. However, it is not. It is right now on this part. Now what we should do, what will happen actually, the market knows that the return is higher, and they see this difference between the stock price and the theoretically correct price is different. So what they will do, all will start buying it. So if all start buying this stock, what will happen? The price will start increasing. And what will happen then? So the next is, we use the formula from the first part of the last session, is that the return of the stock is return of stock A equals to cash flow plus P1 minus P0 over P0. And as I told you, if the prices increases, it's inverse relation, so the returns will fall. So this stock will start falling back and come back to this line, on this line. Now let's take another example. If the stock B, there is a stock B that is under the line, you can see the blue line, and its theoretical price is correct on the line SML. Now since it's below the line, what should we do? Now the market will know that its return is lower than the theoretical return that it should offer, that is greater than 11%. Now it's offering somewhere 7% for the same level of risk. Now what should we do? We will normally sell it, because it is the market is not paying the right return. When we start selling, what will happen? The price will start going down, and if we use the same chronology, the P0 will start falling, and so the return of the stock B will start increasing, and so it will go up on the line, and it will be correctly priced. So the stocks moves up and down the line all the time. However, what we theoretically believe is that the correct line is SML. Stocks goes up, we normally buy the stock, and when it's under this line we'll sell, and this behavior will lead to the pricing, the mispricing of stocks to be eliminated, and it will come back on theoretically correct line. The market beta is always equals to 1. That should also be remembered. Now there is possibility of inflation shifts in SML, and you can see that if the inflation increases and the risk-free rate increases from 7 to 10%, then what will happen? The entire line will shift upwards. The entire line will shift upwards. So the only shift, or it can go also shift downwards if the inflation falls. This is one of the special cases of security market line, where we have to take into account the shifts in the line. Now risk aversion, as we saw before, risk aversion is about type of investors who expect high risk, high return. So if the market risk return profile changes, it was previously 4%, and if it increases to 7%, now the market is demanding more return for the same level of risk, the curve will move upwards and it will shift upwards. Similarly, if the market return risk premium falls, it will come back to this or a level below than this. So the risk aversion also helps to SML to move up or down or shift up and down. And this is the second case that we need to remember. Now, so the CAPM basically relies on historical data. We have no alternative to this. Um, Many sophisticated systems exist. However, still most of the research or most of the calculation depends on historical data. And since betas are depends on historical data, we cannot expect that it will be reflecting the future variability of returns. So past data cannot predict future is kind of an assumption that restricts the CAPM generality to everyday assessments of stocks or making investment decision based on CAPM. So these we can use it only as a rough approximation. We also know that CAPM assumes markets are efficient. However, this is an unrealistic assumption. Um, and for a given level of risk, there are different types of mispricing, and mispricing creates a lot of different set of risks, different set of returns. Hence, the CAPM is an expectation, it provides an expectation relationship. And there are other forms, for instance, weak form of efficiency, that is a semi-strong form of efficiency that is being studied by the research, and they are they work pretty well compared to a strong form of market efficiency. Now, these terms are not discussed at this level. However, in the future levels, you will see that these terms will pop up more frequently. So in this chapter, the second session, we look at the learning goal 5 and 6. We look at the two types of risk, derivation of the role of beta, when we discuss the characteristic line, and we discuss the beta as a relevant risk of both a security and a portfolio. We also constructed CAPM. We also structured the security market line, discussed the overvaluation and undervaluation. So if it's on top of the graph, it's overvalued. If it's undervaluation, and we have also discussed the major forces causing shifts in SML, which is inflation and also the risk aversion. So if the market risk profile changes, the SML will shift. This is all from the risk and return, and for now, thank you.